what up, everybody? This is Amin. I'm going to be going over how to use post earnings IV crushes and flushes to hit 1,000 to 2,000% plays. So, first off, what we want to do is kind of look at how people play earnings now, and then how, hopefully you could trade earnings going, forward. So, now what people do is, right, let me get this right. So what they'll do is, let's just say that this is an earnings day right here, right? All right, so we'll do a vertical line just on the earnings, just to kind of signify that that's the, after hours of the earnings. This is before earnings, this is after earnings, right? So what people tend to do is, as the IV starts going up, maybe a week, 2 weeks prior, like this, right? That means that the premiums, without actually going up in stock price, will go up in value, right? Because of the implied volatility. It causes premiums to go up in value, or to go down if it goes down. So the IV will naturally start going higher and higher in anticipation for this binary event, right? Because it's like either you hit or you miss, or either it pops or it drops, or it goes flat, but there's some type of reaction, right? Anticipation, we're waiting, there's uncertainty. Uncertainty breeds volatility. So, what people will do is either they'll buy a little early and then they'll sell, right before, or we'll have people who buy pretty much the day of, either right before close or right at open, and they'll buy, a call and a put, right? Or they'll buy just calls, or they'll buy just puts. And so, we go into the after hours, and it is gambling, right? You're just playing off whatever. So let's say, it spikes up, right? It does something crazy, it shoots all the way up here. Then all of a sudden, tomorrow, you're up 500% or 1,000% or whatever. And you're all excited, right? You're like, all right, cool. Not only did my calls hit, but, they're deep in the money now. Excellent, right? But how often does that actually happen? Not as often, right? You can't really be consistent with the earnings. You can maybe play here and there, but it's hard to be consistent, right? Because you just don't know. There's a lot of information that you get right after market close. You have the earnings call, the revenue, the guidance, everything that kind of comes out. And then you also see how the market reacts. If it's a big stock, if whatever you're playing is, Amazon or Apple or Microsoft, then it's going to move the indices too, like the Q and the SPY. So there's a lot of information that you kind of are hit with at once. And then come market open, you're hoping that it actually stays up here, because sometimes what happens is it will go up, get you excited, and then it'll come back down, right? And those suck, because you're already excited. You're thinking about all the stuff you're gonna get. Oh, my portfolio is gonna pop, and it rarely does. So there's an alternative that I've been doing, and I've been kind of explaining to the students and everybody in the Discord and everything, is that instead of playing pre-earnings, why don't you play post-earnings, right? And so what I mean is, when this is the IV, right? So when the IV, the next day, it gets crushed, right? There's no more implied volatility. The move is done, the anticipation, the event is over, so the IV gets crushed. When the IV gets crushed, what happens to premiums? Well, they could go, if you're on the wrong side of the move, let's say that the stock, moved up, then all the puts are going to what? They're going to, 1 cent, 10 cents, $1, and maybe before that, this one was, $10, right? It was like $1,000 option, and now it's all the way down there. Or it could just completely go to 99.9% down. So at that moment, if that has happened to you, it's happened to most of us, what do you typically expect? You go, well, I took a shot, I expected zero, and now I'm gonna get rid of these contracts because I don't care about them, right? So typically what somebody will do is they'll just sell it at whatever the bid price is, just to get it off their hands. And when that drop happens, look at this. It will be at like maybe a penny, maybe 5 cents, right? Maybe like 10 cents, maybe like 20 cents. And once you sell it, somebody else is on the other side buying that, right? Well, if you look at it from a risk to reward standpoint, right? Like this. If this is zero, the bottom is zero, right? And this is kind of how it was. It was at like $1, right? So we'll put like, we'll say the contracts were $3, right? So this was $3. You were hoping to make it go all the way up here to, I don't know, $10 or something, right? And obviously with contracts, you know that you multiply that, right, by 100. So this is actually 1,000, and then this is actually $300 worth, right? And then this is zero. So your risk to reward right now looks a little like, it's not bad, right? Maybe like this, right? Where 3 is closer to 0, but you have a lot more upside. Cool. So when it doesn't work, what happens is, well, this gets completely collapsed down to 5 cents, right? So now we'll kind of zoom in a little bit just to make it smaller. So if this is 0 and the contracts, let's say, go to 10 cents, then this is how much you only have 10 cents before 0, but you have all of this potential back up. And that's post earnings. So now you have all the information. You know what they hit on earnings. You know what they have for guidance. You know how the market is about to open because you're looking at all this during the pre-market. So why not, instead of paying $300 over here, why not spend $50, let's say here, and then let's say that after the earnings, these contracts get from an IV, crush, and the IV just starts spiking. Sorry about that. No, but not the IV starts spiking, but the price, right? We get a green candle or we get a red candle, depending on whatever direction it goes at open. These 10 cents can easily go to 40 cents, right? Let's just say these 10 cents go up to 40 cents. What percent are you up now, right? You're up 400%. So you just made 400% on your investment in relatively maybe a couple minutes or even higher. So I'll give it an example of exactly what happened today. This happened to DoorDash. I randomly picked an example just to show you that it can happen all over the place, right? And I'll kind of go through exactly, how you should play it and all that, right? And I have a little step-by-step. I'll post this in the Discord just so you can see it or reference it. But and we'll kind of go through it, right? So number one is you have to find a stock that has an earnings, on that day, right? Because you're going to be doing it post earnings. So it can be a earnings that happens in the morning, or it can be a after hours earnings. It doesn't matter. As long as the earnings are reported and a reaction occurs, that means next, when the market opens, one side or both sides is going to get IV crushed, right? So if it pops up, then the puts get crushed. If it drops, then the calls get crushed. And then if it goes flat, both sides get crushed. So don't buy before earnings, right? Just give that strategy up. I've never really been a fan of it. I've always been kind of looking for a way to kind of get around it. I used to be the person who would buy 2-3 weeks before and then let the IV pump the stock, and then I sell. But nowadays I don't really touch earnings. But lately this has been a pretty good and easy way to accumulate good returns, right? Because it's all about the returns. You shouldn't really think about the size, because you're not coming in with big size. You shouldn't, because if you can turn $50 into 500, why would you spend more than $50? That's 1,000% return, right? So I'm thinking more, you spend less, so then you risk less emotions, and you can actually exit the play because you're buying it at market open. You're not locked into it, having to sleep on it all night, hoping that it does something different, hoping that it holds. You're in full control of the play from the moment that you open it until the moment that it closes. So and then what I do is I pick 3 strikes up and down, right? So 3 strikes of calls, 3 strikes of puts, just depending on whichever way it goes, right? If it's sideways, you definitely look at both. If it's only one side, then you're probably going to be playing the opposite side, right? And then you're going to add it to your watch list in the pre-market, so you can actually view it when the market opens. These things are going to completely dump, right? So you're going to see the low of the day, immediately get tapped. People are just trying to get out, And that's when we'll go into the next steps, but um, those are the times where you want to be able to put a limit price, scoop them up, so that then when the bid ask comes closer together, the spread is closer together, and price maybe even pops up for the first 5-10 minutes, you could immediately get a quick return and then just get out, right? Um, so an example, and we'll be using DoorDash, is the I had 70 calls, 75 calls, the 80 calls, and then I had the 70 because the price was at $70. So I just did three strikes up and three strikes below, and I spaced them apart by fives and zeros. That's kind of how I like to do option strikes. I don't really deal with the ones in between. Number four, right, and this is important because it's going to give you higher odds. Right? It's not a guarantee that you're going to come out on top, but you want to be in the direction of the market, right? You don't want to be buying a call when the market is tanking at open, right? But if the stock price, let's say there was it gapped up, so you were going to play the put side, but then the market wants to go down, that's perfect. The market will help you beef up those IV crushed puts that you're going to buy at open, right? Number five, have a predetermined risk amount. I'd say anywhere from $20 to $100 for most people. I don't say go higher unless unless you've done this enough times to where you have a good success rate, you can document it, anything like that. And then also depending on your account size. But honestly, anywhere from 20 to 100 is totally fine. That way you can literally do these every day, because especially during earnings seasons, you could do a different earnings every day and try it out. And let's say you stick with the same price of $50, and let's say one of them hits 1,000%, right? And it goes from 50 cents to $5, right? If that happens, then you just now paid for the next, anywhere from 5 to 10 attempts for the next few earnings, right? Depending on if you do a 50% stop loss or a complete to zero. Because right here I say either use a 50% stop or expect zero. Usually I like to expect zero. That's just my personal opinion, because since the bid ask is spreading so much, sometimes it'll hit your stop loss and then rip, right? So I expect zero, or at least until the price action, or I have enough candles to kind of determine that, okay, this thing's not going in the direction that I thought it was going to go to. So I'm just going to cut it, right? So, let's say, yeah, you hit a $50 play, it turns to 500, and then now you use that 500 for the next, 5 to 10 plays, you're set, right? You're not going to feel like, oh man, I'm losing this. And then all you need is one of those to hit again, and then you just keep the cycle going. And by the end of earnings season, you might have, some cool stuff, cool profits on the side that's just been stacking up. Number 6 is set limit order on the contracts that get IV crushed but aren't too out of the money. Use the average stock range. So just like with DoorDash, I had pretty much like 10 up, 10 down in price, and I was like, that seems to be a pretty accurate depiction of how far price can go. So that's what I'm going to use when I pick the option strikes, and knowing when you've hit your target or when you should get out. And then number 7 is if at open, I said if the open is neutral, buy a call and a put, and the winner will most likely pay for the loser and more, right? Or pick a side for a 50-50 attempt. So on DoorDash, which I'll get to, it actually opened up pretty much where it closed. So both sides got crushed. So you could have spent, let's say, $25 or $50 on a call, $25 or $50 on a put, and whichever one, the direction went into, that would be the one that would pay off the losing position, right? So that's the good thing about going into, getting a call and a put at the same time, right around open. As long as you limit price and you make them pretty equal, then, you should be okay. Or if you just, you're looking at the indices like the Q and the SPY, and you're seeing that there's a strong downtrend and you just want to go into puts, you could do that for the 50-50 attempt, right? Because you flip a coin, it's either going to go up or down. And then how would you manage it? You can either scalp it at the opening 5 or 10 minutes, right? You can get that early morning just rush in. You can get that quick candle and then get out. Or you can actually hold them if the direction is decisive and strong. So, if you open up and it has a really strong move, and then all of a sudden you find it, having support and then it wants to go higher, then yeah, you can continue to hold it. I've seen people hold it for a day, 2 days sometimes, and get back crazy returns. But I've seen other people where they just get in and get out with a quick 50%, 100%, 200%, and then they call it a day, right? So here's an example that I'm going to show. So where is it? Give me 1 second. All right, cool. So this is earnings right here, right? And I'm going to put on the after hours so I can kind of show what happened. So this was the closing price at this white line of $73. And they reported earnings and they gapped up exactly like the example I showed in the beginning, where people who had calls, let's say who had the $80 calls, were so excited 5 minutes after market close, but by the time the market opened, right back to where they were, right? So these up here got crushed, these down here got crushed. But once the market opened, if you look here on the SPX, we started falling, right? The market just started pulling back right here. The market just started pulling back pretty dramatically right there. So DoorDash followed suit, right? And it actually hit a low of 63 before bouncing all the way back up to 76. And now I'm going to show you guys what happened in the option pricing, right? So the first one we're going to pull up is the 70 put, right? So we're only looking at the puts because the price went down. The 70 put, if you look here, and I'll full screen it, right? It opened down here at $1.59, and it had a high 10 minutes later at $7.10. $159 to $710 in 10 minutes post earnings. And you didn't even have to get the bottom. You could have got it here, you could have got it here, 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 anywhere in this area, and you would have had a great return, right? But I totally understand $100, $300. Who wants to throw that into something they're trying out, right? Okay, so let's move down and strike. So this is the $65 put. So the $65 put opened up at 40 cents. This is starting to look more like the price range I was talking about, right? It went from 40 cents to $3.33. $40 to $333 in 10 minutes post earnings, not pre-earnings. All those people got crushed. You're getting all the information, you're sliding in, you put a limit order at $50 right here, you get a fill at 50, and you take it up to 100, you could sell there. 150, sell there. 200, 250, 300, right? And look how much time you had before the contracts actually came back down. You had almost a whole day. So, but let's say even that was a little too much, right? Let's just say that was even too expensive. We'll go down to the 60 put. The 60 put had a low of 1 penny, and it went up to $1.19. 1 penny. Imagine if you got the fill at 5 cents, because we can't get fills at a penny, right? But imagine you had a fill at 5 cents, and you took it from 5 cents to $1.20. 5 cents to 50 cents is 1,000%. 5 cents to $1 is 2,000%. This is in the range of like 2,200% if you took it just from 5 cents to $1.20. And these are the dash puts post earnings. So hopefully this will kind of help out. And if you have any questions, definitely let me know. I'll try to answer them as best as I can. But try these out. Try out the IV flushes, right? Because where did my list go? There we are. But yeah, try this out. See if it helps, because I think all you need is 1 or 2 of these to play out, and then now you have a lot of cushion for your next plays, right? And you could kind of try these out while the market's kind of figuring itself out. All right. Thank you guys. Peace.